Welcome to Podcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, and I'm joined today by our global market specialists, Giovanni, Zanni, and Cummins. Okay, we're recording this on a Thursday off the back of another busy week with the war in the Middle East still dominating headlines and driving quite volatile market moves, albeit we are starting to get a little bit of a sense, I think, that there's some headline fatigue starting to creep in. And this fatigue with this sort of back and forth in the headlines did allow markets at times to focus on other things, albeit sometimes only momentarily this week. We obviously have a lot to talk about in the week ahead with the upcoming central bank. So it's great that we have two economists joining us on the pod this week. But before we do look ahead to that, I think probably just worth touching on a few of those things that markets were focused on. Kevin, I'll start with you. We had a relatively busy data week in the US this week, most of which was pretty strong, I suppose you'd characterize it as. Can you just run through what your take is on all of that? And perhaps just quickly before you start, I should say to any of our listeners that they should be listening very carefully because Kevin was ranked by the Wall Street Journal out of 73 economists as one of the top most accurate forecasts last year for his growth, inflation, and Fed funds predictions. So definitely worth listening into to your take on the economic data this week, Kevin.
Well, you're very kind. Thanks, Imogen. Yeah, I think you're right in the characterization that the data this week were pretty constructive. I mean, this morning we had weekly jobless claims. And then on Tuesday, we had a very strong retail sales report. It does appear that the consumer has kind of withstood the energy price shock pretty well so far. I mean, based on those data. In addition to the strength that we saw in the headline index of retail sales, there was a little bit of an upward revision in February as well. So I think, the big worry is how much the hit to the consumer from higher energy prices are going to potentially slow consumption growth going forward. And we got a little bit of information from that, and it was pretty encouraging. I mean, obviously the retail sales data are based in nominal terms. So the fact that gasoline prices were up over 20% on the month, you're likely to get a big boost from that component alone. But even if you look at underlying core measures like the control measure of retail sales, we saw the strongest gain in 8 months. Control measure was up 0.7%. And those data feed into the consumption data that the BEA includes in GDP. That was very encouraging. We had been running in our forecast for GDP, we had been assuming about 1.6% annualized consumption growth for the first quarter, and it still seems to be on pace. I think going into the report, we were pretty concerned because January and February consumer spending data were only, adding up relative to the fourth quarter, sub 1%. I think it was at a 0.7% annualized rate. So the fact that the retail sales ended the quarter as strongly as it did, it kept our kind of long-standing estimate, or at least closer to that estimate. So right now, it appears that consumption is running or ran in the first quarter up 1.4% annualized. So that, given the fact that consumer spending in the U.S. after accounting for imports is probably about 60%, that suggests that next week's GDP report, we could see a bit of a bounce relative to expectations for some further slowing in the first quarter. In the fourth quarter, overall top-line GDP missed and was much weaker than expected. The jury is still out, I think, on the consumer. Obviously, we've had a hit to consumer sentiment, real income growth as the labor market slowed last year has really been limping along here. So I wouldn't necessarily extrapolate the good results in March too far out. Part of it may also have reflected really unusually warm weather across the country. Average temperatures were really above seasonal norms, so that may have had some positive influence on the retail sales goods portion. And then in addition to that, we had an unusually large tax refund season. And refunds were up almost $15 billion higher than they were a year ago. So presumably that cushioned the blow from higher gasoline prices that consumers are facing. And that's likely to persist in April, but after that, it's probably going to decline pretty markedly as the tax season draws to a close and after April 15th. So the outlook is still pretty cautious moving forward, but for what it's worth, these data this week, as you said, were pretty constructive.
Yeah, we had a fair amount of data out of the UK as well, and I think probably constructive is the way that you would describe that. I think when you add the kind of data that we had this week to the GDP data that we got last week, we're starting to see mounting evidence that this is an economy that was on relatively firm footing. Price pressures were, they too were mounting. My focus was probably on the labour market data in the UK, just because that appears to be where I think the biggest difference of our view compared to what it feels like market consensus is stems from. We've talked on this pod over the last couple of weeks about how we have a relatively more hawkish view for the Bank of England. That stems from this perception, I think, that the labour market is weaker than it actually is, and that will prove an impediment to the Bank of England hiking rates. Whilst we did see some weakness on the PAYE employment data in the UK, wage inflation beat expectations, and that remains way above levels that would be consistent with meeting the CPI target on a sustainable basis. Similarly, on the inflation data, we saw an upside surprise on the service price inflation. It remains well above 4%. That's even before the full effects of the current energy price shock have been felt. And then we saw an improvement in the PMIs as well this week. And notably, I think, certainly from a UK perspective, we saw a surge in that service prices charged index as well. So a set of data that historically has been quite well correlated with a lag to service price inflation. From a market's perspective, I think it's interesting that despite all of this data pushing really in what feels like one direction, in a more hawkish direction, the market reaction immediately following the release has been quite muted. We have had quite a bit of UK rate underperformance this week. We generally have had, that curve still bear flattening, so pricing in more rate hikes than previously. But it hasn't been tended to be driven immediately by the data, but more so I think the tone of the headlines out of the Middle East, and then the data's just sort of reinforced and supported our view that it might be most difficult for the BoE out of the major central banks to look through those, the likely inflationary pressure that the global economy is set to experience as a result of the war. The final bit of data that they worth mentioning this week in the UK was the public finance data. And really that's just because I've talked about it for the last 2 weeks on the pod as something to watch. I was talking about the April remit revision that was published off the back of the March public finance data. And in the end, what we saw was actually a bigger downward revision to borrowing than we were expecting. We penciled in just a 2 billion reduction in gilt issuance this upcoming fiscal year. But actually what we saw was a £6 billion reduction. But I think the more important point to focus on here was not around the overall borrowing number, but the way that the bucket split may or may not change. And we'd been pushing back quite strongly on the idea that any reduction in borrowing might come from the longs bucket. A big driver of that was the curve flattening that we'd seen between the spring statement when the bucket sizes were first published and the April remit revision, which was published today, which meant that value for money calculation that the DMO does on where it would be most efficient on the curve to issue debt had shifted quite considerably. Proportionally, the bucket sizes stayed very similar, but I think that was quite an off consensus view that longs bucket wouldn't shrink, and that's really been the only thing that has put a stop to the UK curve bear flattening this week, and we're seeing a little bit of bear steepening, although of course it's not undoing all of the flattening that we'd already seen, and it's still UK rate underperformance. It's just at a different part of the curve. Okay, let's jump back to the US because we also had Fed Chair nominee Warsh's Senate banking hearing this week, Kevin. He was very focused on the balance sheet and also on the importance of Fed independence.
Obviously there was a lot of anticipation because we haven't heard from Warsh since he's been nominated by the president. heading into this year, he had spoken a lot about being certainly leaning much more dovish than what's priced into financial markets at this point. We were curious, obviously, as was the market, to see if his views have changed and whether or not he was going to align more in line with, the new market pricing over the past couple of months versus the last time he spoke last year, and seemed much more dovish. And I think from that perspective, he didn't really give too many indications that his dovish leaning views have really meaningfully changed. Our own view is that inevitably, when he gets into office, I think he's going to move, or at least argue to move rates back down closer to the Fed's estimate of neutrals. As you mentioned, one of his top priorities once he arrives at the Fed is to begin tackling the Fed's balance sheet and getting the balance sheet down. From that perspective, offered a little bit of caution and didn't seem to have come out with an exact plan he's going to unveil immediately. So from that perspective, it does seem to kind of fit into the idea of something that the Fed's going to address, but perhaps not by the end of this year, for example. So I think it's going to be kind of a work in progress there. He obviously stressed the importance of Fed independence as well as price stability. But and talked about a slew of changes and a new inflation framework, for dealing with persistent inflation. He had kind of big ideas, but he didn't really offer too many specifics about how to address that. He was asked about whether or not he's going to continue with press conferences after each FOMC meeting, and he really didn't come hard in one way or the other. There's been a lot of talk over the course of time, actually since it began, whether or not the Fed is going to drop their dot plot or their SEP. He didn't touch on that just yet, but I would imagine just kind of listening to him and talking about limiting forward guidance from the Fed and being able to change their minds based on how they perceive the economy to perform, that's probably something that we're going to see either reworked SEP and including risks around that forecast or dropping the whole thing entirely. At the end of the day, he made his case, I think, strong enough that eventually, when there will be a vote in the Senate Banking Committee to nominate him to the chair, that he would pass. But how quickly Warsh will come into office is very unclear still at this point.
Okay, that brings us nicely on to next week, where we obviously have a Powell-led Fed meeting. So can you talk us through what your expectations are?
There's very little pricing for any action this year. So, in the near term, I think Powell is likely to reiterate kind of a wait and see approach. Obviously, there's no action expected on the Fed at the conclusion of the upcoming meeting. But even by the end of the year, it's, very little easing expected. It probably allows the Fed to keep very much intact most of the FOMC statements. They probably will tweak a line here or there in the current conditions paragraph. But as far as the forward guidance and the overall tone used in the statement, I don't expect it to really have many meaningful changes here. I think the Fed's very much waiting to see how things unfold. I think if the Fed were to surprise us, that if you look at the FOMC minutes in March versus January, there does seem to be a little bit of a growing list of officials that are at least raising the possibility of including a bit more balance of a risk assessment in the FOMC statement to a bit more two-sided with regard to future policy in the statement. But I think it's very much based on how the inflation data have done. If you look at the January meeting, several participants indicated that they would support a two-sided description with regard to future interest rate decisions. And then in March, they pushed that a little bit higher and said that some officials want to change that language to a more balanced two-sided risk with regard to future policy. So, and I think what will drive that is the inflation data. And I think, if anything, from the March meeting until next week's meeting, the backdrop really hasn't changed enough to warrant a change there. So I don't think that they're going to do that. But from January to March, you did see a growing number of members. It's still a minority, but they're getting a little bit more uncomfortable with the idea that there's this one-sided risk in a dovish lean. The fact that the inflation backdrop of that we've had since the March meeting has been, if anything, probably a little bit better than they thought at the timing of the March meeting. It probably doesn't suggest enough to warrant any sort of change to the statement itself.
Okay, now is probably a good time to bring you in, Gio. You've been waiting very patiently, but it is, of course, an ECB meeting next week as well. Like Kevin said, there's very little expectation priced into markets for any rate move next week. But are you watching for any, I guess, more clear forward guidance on what, the policy path ahead, or anything that might change your base case?
Well, I think to stress is the communication to the meeting, because if you remember, pricing to a large extent the possibility of a rate hike. We don't dismiss it, of course, but I would just say that for me the bar for a rate hike is higher than what it seems to be assumed by markets. Of course, it will depend on what happens to the Middle East conflict, on the duration, on the second round effects, on the inflation expectation, the persistence. So all the things need to be carefully assessed. But if you can avoid hiking rates in this context, then that's what you should do, because you're just complicating things, and you only do it if really warranted by some sense of the anchoring of expectation. One last thing that I would want to mention is that there's a lot of discussion about, also from the ECB, saying, oh, we are between the baseline and the adverse scenario, as if the baseline was for no rate hikes, look through, and the adverse scenario was for a more certainty of hiking rates. Well, I don't really agree with that, because if you look at the adverse scenario published by the ECB in March, it actually implies inflation going up more to 3.5% this year on average, but then falling back quite dramatically to 1.3 in H2 2027 due to base effects, and then staying very close or even below still to 2% in 2028. So it will be an empirical question, and as I said, the language will try to be always a bit more hawkish. There will be an hawkish bias to reinforce credibility, but then on the action side, I think that it will be driven only by this real sense of the anchoring. Otherwise, there will be no action again.
Okay, that makes sense. And I actually think a really useful run through, because we've been talking on this podcast over the last couple of weeks about the kind of disconnect in a way between Bank of England pricing and ECB pricing. And it's felt for a long time that, sort of as you mentioned, that the market was or interpreted ECB communication differently to the way that we have, and certainly interpreted maybe the implications of the data as well. So I think it's nice to hear from your perspective that kind of reinforces what we've been saying for the last couple of weeks, that it feels like the market should be pricing in more for the Bank of England than it is for the ECB. Maybe I should just round out our kind of trio of central bank meetings next week with what we expect from the Bank of England then, which, to Gio's point about how the ECB were quite hawkish initially in that March meeting, and then haven't needed to be so hawkish since, I would say that actually the Bank of England, we had quite a pivot in their communication. If you think pre the March meeting or pre the war beginning, we were still on this path of the Bank of England signalling, rate cuts were likely, or at least one more rate cut was likely this year, we felt. And they've pivoted on that quite considerably in the more hawkish direction. They've dropped any language around bank rate cuts, and instead in their formal communications replaced that with lots of language about being concerned about potential upside risks and putting policy tightening back on the table. And we've really just had that message almost word for word from individual policymakers repeated since the March meeting. So I don't think the messaging from the Bank of England has changed, or really has needed to change over the last couple of weeks. They've been very clear that they are waiting for evidence of second round effects. And realistically, it's still far too early to see any evidence of that would make them either compelled to act or think that they can resume on their previous path of monetary policy loosening. So I think when we think about the meeting next week, probably, certainly from a market's perspective, I wouldn't think of it as being anything more than a placeholder meeting. I don't think now, we've already had the big kind of communication or forward guidance pivot from the Bank of England. And I don't think now is the moment for any of that to change. I think even the most hawkish MPC members, and maybe with the exception of Catherine Mann here, the most hawkish members appear to be comfortable keeping rates on hold. And I think you would say the same for, the more dovish end of the spectrum as well. So most likely, I think you get a unanimous 9-0 vote for unchanged rates at the April meeting. It is a monetary policy report meeting, so unlike the Fed and the ECB, we do get an updated set of projections. They might get a little bit more attention, given that it will be useful to see the way in which the Bank of England, sees in their sort of best guess or base case scenario, sees the impact to inflation and growth. But I think given that these projections are being published against a backdrop of, unusually or much higher than normal uncertainty, from a market's perspective, it may render them a little bit obsolete. I guess similarly to what Giovanni was saying with the ECB, we've sort of long argued that April had felt far too early for any rate hike. The MPC have been quite clear that they're waiting for, evidence of second round effects. Perhaps they don't need to see all of the data to be comfortable with whether those second round effects are appearing or not, but there needs to be a bit more concrete evidence of that, and April was always going to be far too premature to see that evidence. And markets have slowly come on side. They're not really pricing in anything by way of rate moves, but similarly to what they are in the euro area, markets still seem pretty convinced that rate hikes are coming sooner rather than later. Cumulative market pricing for policy tightening through the year or through the next 12 months doesn't appear kind of overly hawkish, I would say, compared to our current base case. Now, obviously, market pricing has been quite volatile. It's moved a long way in both directions over the last couple of weeks. But what we have now, which is broadly looking for around 2 rate hikes over the next sort of 12 months, is actually pretty similar to what we pencil in. We have 2 rate hikes over the next year. So I wouldn't push back significantly on the overall degree of tightening that markets are looking for. But the 2 points that I would make where market pricing isn't very aligned to our view is, first of all, on the timings of the timing of those hikes, which is something we've discussed on the podcast before, that markets remain pretty confident that the bulk of any policy tightening, if it is delivered, will be during the summer. The market's got most of those 2 full rate hikes priced by September, whereas we just think it might take a little bit longer for evidence of those second round effects to appear, and therefore we see those rate hikes coming later rather than earlier. We don't have the first rate hike in our forecast until Q4, with likely a follow-up hike in Q1. And then the second point, which is what I already mentioned a couple of minutes ago with regard to the difference between Bank of England pricing and ECB pricing. Again, that's moved a long way. We were recording this pod, I think last week, and there was probably about 1 full hike more being priced into the euro area than there was in the UK. UK. Now it's only very marginally more, a couple of basis points. But I think the point for me, which, well, Giovanni put so eloquently really, is that the pressure doesn't appear to be on the ECB to hike, whereas the Bank of England is different from the Fed in the sense that it doesn't have this dual mandate, but it's also different from the ECB in that it is still fighting. It's sort of, it still hasn't won its previous fight on inflation from the last energy cost shock. We still have service price inflation well above 4%. We still have wage inflation at levels that aren't consistent with meeting the inflation target on a sustained basis. So, we are still of the view that you are more likely to see rate hikes this year from the BoE than from the ECB. And so whilst market pricing has moved a long way, I think there is further to go. That said, I'm not sure that next week's meeting is necessarily going to be a big driver of any repricing. In some ways, I think for the market to reprice those kind of near-term hikes that it's got in the June and July meetings, it's more about just the passage of time rather than anything that we're going to learn from central bank communication over the next week or beyond. It's more like the closer we get to those meetings, the more obvious it will be that the Bank of England actually isn't ready to commit to needing to tighten policy. So there's not really one thing or another that I'm watching out for necessarily over the next couple of weeks that will necessarily, move markets much closer to our view, apart from perhaps headlines, coming out of the Middle East. But I think it's more just the passage of time. As we've seen with the April meeting, market expectations were pretty high for action in April. And the closer that we've got to that meeting, the less those expectations have become. So let's see. Away from central banks, though, just to finish off the podcast, is there anything else that either of you are focused on for the next week, either something that's going under the radar or something that you just think markets aren't looking at as closely as they should be? Kevin, maybe I'll start with you.
One thing I think that bears watching is how things and conditions are in the labor market, because in our forecast, we do think that consumption is taking a step down here, despite the strength that we saw in the retail sales report that I talked about earlier, moving forward, partly because we're expecting the unemployment rate to go up. So I'm particularly interested in some of the kind of second tier employment data that we'll get next week. In addition to the headline Conference Board Consumer Confidence Index, it's something that people watch pretty closely with the labor market differential there. ADP has come out with this weekly private payroll data. And for what they're worth, I did get some questions in response to the reported strength in the report that we got on Tuesday. That showed an average 50 or so thousand jobs were added in the on a week-to-week basis in the 4 weeks ending at the start of April. So, if you were to extrapolate that, that would be consistent with something in the neighborhood of plus 220 or so on payrolls. But we all know that ADP has a very poor track record. These weekly data haven't been around too long. Obviously, with weekly data, they're subject to difficulty properly seasonally adjusting and things like that. So I wouldn't put very much stock in that weekly ADP data. But it definitely bears some watching moving forward. And then, in addition, as I mentioned in the Conference Board survey, that the labor market differential, I'll of course be watching jobless claims, because they really haven't shown any sort of meaningful pickup in layoffs just yet.
Perfect, thank you. And same question to you, dear. What are you watching out for in the week or weeks ahead?
Next week we'll have more data in terms of surveys. We will have the GDP, the first flash estimate for Q1, but it's a little bit back mirror kind of information. The key data next week will happen the same day of the ECB meeting, which will be the release of the inflation flash estimate for April. So, if it's, for example, surprisingly high, let's say at 3% or higher, that will be a surprise. But, I would expect it actually to come slightly lower than the current estimates of 2.9. And then there is all this kind of political situation that was a little bit frozen between the elections in Hungary and now with the victory of the opposition to Orban, things might change. There's a council meeting as we speak. So this is the kind of a situation might change a little bit the situation in Europe. Europe that has been, frankly, quite absent from the current geopolitical problematic situation. The ECB meeting, what they will be saying, although it will be a placeholder meeting, will let's say set the stage for what we have to look at for let's say in the next couple of months, basically.
Thank you, Gio. I would say in the UK, it's quite similar to what you were saying from a political perspective. I don't know that it's a necessarily under the radar or niche thing, but we have Morgan McSweeney, who is Keir Starmer's ex-chief of staff, up in front of the Foreign Affairs Select Committee. And that's part of the ongoing investigations into Peter Mandelson's appointment. And I raise that not because I think that that's necessarily going to be a sort of smoking gun in any way when it comes to Keir Starmer's tenure as leader of the Labour Party. But I just think that markets at the moment are a little bit dismissive of political risks in the UK. And when we entered the year, political risks was one of the reasons why we had a higher than consensus gilt yield forecast. And whilst the timing of those risks might have shifted, I think that, if we were to think about the risks that gilt face at the moment, we would describe them as having a double-edged sword, in that we're underperforming in sort of global rate moves. But as soon as markets move on from the geopolitical events of today, focus will return to the domestic issues that the UK faces. And I think those political and fiscal risks that it brings with it should also push in a higher yield direction, albeit with a steeper curve rather than a flatter curve this time. So it's political risks that are on my radar as well in the week ahead. Okay, I think that's enough this week. We have talked long enough. Thank you both for joining me. It was very pertinent to have two of our economists on the week before big central bank meetings. So thank you for your time today. Thank you for our listeners to listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other NatWest podcasts, Currency Exchange and Trade Links. Thanks. See you next week.